Bay. It is certainly a privilege. I've done it 10 years now, a little over 10 years, and it gets more and more exciting and more fun every year. There's someone who did it almost as long as I did who's here, and I want you all to meet the founding CEO of the Community Foundation Tampa. Wait, where's George? Would you stand up, George? He continues to mentor me. We would not be where we are today if it weren't for your faithful attention to the Community Foundation. So thank you, George. When George started, he told me his first gift into the Community Foundation was $100 from a teacher friend. And now we have assets that we just heard at the end of the fiscal year, totaling $667 million. I want to welcome all of you. I got to speak to many of you in the reception room, and I hope to meet all of you to this very first in an ongoing series of really high caliber educational programs. So Sam, you need to live up to that now. Very high caliber educational programs for professional advisors that we will be offering, the foundation will be offering on a regular basis each year. So this is the very first, the inaugural one. So welcome, and we're glad to have you all here. We appreciate the work you do as professional advisors. You're so important to our being successful in stimulating philanthropy throughout the area, and we're very, very grateful for that. We're pleased to work alongside you and to inspire and educate your clients about charitable giving. Know that we're happy to do that no matter what their final decisions are. Our bottom line job is to build philanthropy for all of the wonderful nonprofits that serve the Tampa Bay area. Our staff has expertise that you can call on when working with your clients and their planning. You're going to be meeting them and hearing from them. I'll let them introduce themselves when that time comes. CFDB helps to align your clients' passions with community needs and opportunities. And we use both of those words very purposely. Sometimes it's really fun things like a new building for an arts program, and sometimes it's very necessary things like housing for people who are unhoused. We featured the Arts Alliance, St. Petersburg Arts Alliance in the reception because it's a great example of one of the organizations that shares our vision of bringing together arts and culture and projects that engage our community. And that project checked all of those boxes. The St. Petersburg Arts Alliance is just one of over 1,200 nonprofits that were funded and supported just in fiscal year 2023, over 1,200 different nonprofits. We appreciate you. We appreciate your clients continuing to invest in our community. And we know that we'll continue to grow charitable assets for this community with your help. And we can all learn to do our jobs better, which is why we're so pleased to have the very esteemed, and I know he's going to be a great speaker with us tonight. A good portion of the assets that we hold are actually managed through our IMA program, which is individually managed charitable accounts, IMCA. They just added the C recently to throw me off. Individually managed charitable accounts, which means that a trusted advisor who's already been working with the client for perhaps many years can continue to manage those assets as adjunct to our own pooled accounts that we manage with our investment committee. So explore that. If you want to know more about that option, please let us know. But we've got that seamlessly worked out so that it works for everyone, the donor, the advisor, and the foundation. And most importantly, it works for the community. I'd like to introduce someone to you now who's a member of our board, Ron Saganek. Ron is the retired executive vice president of the Valley National Bank. He is a member of our board, as I said, and he chairs our Council of Professional Advisors. Ron?
Thank you all for coming tonight. I want to thank our Council of Professional Advisors. It's a group of your peers who act as a sounding board for the Community Foundation of Tampa Bay. And they provide guidance in the best ways to engage with professional advisors in our region. They provided leadership in curating this event tonight. I also want to express our appreciation for the opportunity that we've had to collaborate with the 4 local estate planning councils: Gulf Coast Estate Planning Council, Pinellas County Estate Planning Council, Suncoast Estate Planning Council, and Tampa Bay Estate Planning Council. As we planned this programming, the leadership of all 4 councils provided helpful input, and we look forward to continuing to work with you all. Next, I'd like to introduce Lori Valentine. Lori joined our staff in July of 2022 as Counsel of Philanthropic Giving after leaving her estate and tax planning law practice. She brings a wealth of knowledge and experience in the areas of charitable gift planning and estate and trust administration to the Community Foundation of Tampa Bay. Welcome, Lori.
Thanks. And let me tell you, I am so pleased to see this room full of folks. This project was handed to me by Sheila last year, one of my first assignments, and she said, figure it out and let's have one in the fall of next year. So anyway, thank you all for being here. I just can't, and I cannot thank the whole team. We have many, many folks from Community Foundation Tampa Bay staff here, and this could not have happened with all of them. So thank you all so much. I get the pleasure of introducing Professor Sam Donaldson to you. He is a professor of law at Georgia State University in Atlanta. Prior to joining the Georgia State faculty in 2012, he was on the faculty at the University of Washington School of Law in Seattle for 13 years, where he served as director of the law school's graduate program in taxation. At Georgia State, he teaches a number of tax and estate planning courses, as well as courses in the areas of property, commercial law, and professional responsibility, ethics. Sam is an academic fellow of the American College of Trust and Estate Council and a member of the bars in Washington, Oregon, and Arizona. He currently serves as the tax editor for the Probate Practice Reporter. Among his scholarly works, Professor Donaldson is a co-author of the popular tax law school textbook, Federal Income Tax, A Contemporary Approach, and also co-author of Price on Contemporary Estate Planning reference volume published by Walters Kluwer. Please help me welcome Sam.
Thanks very much, Lori. I appreciate it. Hi, everyone. It's a great distinction to be the inaugural speaker at the Outstanding Speaker Series. It's a dual honor. I am simultaneously the best that this event has ever had, and also the worst that this event has ever had. So there's comfort, at least on both sides. You can decide for yourself which side of the fence we ultimately end up on. Our job here for the next hour, the reason why you were carbo loading next door and swigging copious amounts of wine, as you'll soon learn, it was not enough. Because we're going to be taking a look at all of the big income, estate, and gift tax developments over the course of the last year or so-ish to have a handle on what's going on. Ultimately, your goal for tonight is to learn nothing new. If you come here tonight and everything that we talk about is brand new, you really need to get out more and be a little bit of a better professional, but at least maybe we can start to reach a few consensi about how all of this is supposed to work. There will be written materials that you will receive after this event. So check your spam folder because when you get a big old honking PDF attachment that's going to have 105 pages of written materials, it makes an excellent doorstop. Or something to hold a window propped open if you would like, but that will serve as a good set of reference materials that you'll have there for it. We'll try to cover all of the important stuff in more or less the order in which it's presented inside of that written materials. And we will start by taking a look at the inflation-adjusted federal income tax brackets for this year, 2023. If you haven't done so already, I'll give you a moment to ego surf these brackets. Whenever new tax brackets come out, my first instinct is to think, ooh, what bracket am I going to be in this year? Still 10%. Yeah, well, that's all right. In effect, no news is good news here because the brackets are essentially unchanged as they have been since 2018. What we have seen, of course, are just the inflation adjustments to get into them. This year, in case you didn't notice, if you're married filing jointly, you're not going to hit the 37% bracket on your ordinary income until your taxable income is very darn near $700,000, a very high threshold from the $450,000 that it started with just back in 2018. Of course, we still have the same rates that are applicable to dividends and adjusted net capital gain income. There's still that 0% bracket out there. Every December, we always see homeless individuals always cashing in all of their capital gains to take advantage of that 0% bracket. We call it unicorn capital gains because we're not entirely sure it really exists. But for all those low-income taxpayers who have capital gains, they're paying 0% on it. For middle-income Americans, or as I call them, academics, there's still a 15% rate on dividends and capital gains. And it's only your clients who find themselves in the upper brackets that are paying 20% on the dividends and capital gains. But let's be honest, by definition, if their taxable income is high enough to put them at 20%, they're also paying 3.8% on that net investment income as well. So it's really 23.8%. Now, don't let this get out to the folks in Tallahassee, but there are states that impose state income taxes on top of the federal income taxes that are here. And so some people, especially when they live in one of those cursed states, will say, dang, even though these brackets have stayed the same for the last several years, they still strike me as being high. And if that's the case, just be thankful that you're not an estate or trust. Be especially thankful you're not an estate, because that requires a certain degree of commitment that unless you're Ted Williams, you're not getting out of anytime soon, right? Any day you wake up and you're not in the state, it's a good day, my friends. But for trusts, which are treated as separate taxable entities, oh, good gravy, right? Nominally, they have the same brackets, 10 to 37%, 0, 15, and 20. But geez, talk about anemically thin tax brackets. A trust treated as a separate taxable entity that has just $15,000 of undistributed income is paying 37% on its ordinary income, 23.8% on the dividends. And for most trusts, if they have ordinary income, it too is net investment income. So they're really looking at paying 40.8% on that income. That is why still, in the lion's share of cases, when we are designing trusts for clients, we're designing them either as grantor trusts so that we can take that undistributed income and slap it onto an individual's return where chances are we're going to pay substantially less in tax. Or we bring out Section 678 of the code and we tax the beneficiary on that undistributed income. Being a passive-aggressive individual myself, I love Section 678 because it's this wonderfully passive-aggressive provision that taxes the beneficiary on the income even though they don't get to touch it. Maybe next time when we set a curfew, you'll be home on time, right? As we design that trust. But as long as we can take that undistributed income and put it on an individual's return, much better chance that we're going to be paying less in tax. We've already talked about inflation adjustments, and just to kind of confirm that, yeah, inflation really was kind of a thing, let's talk about what's happened on the estate and gift tax front. First, look at the gift tax annual exclusion. Those of us that have been in the trade for a long time, we remember where the annual exclusion was at $10,000. Heck, we even remember smaller amounts, but we pretend that that was our parents. But we remember that there was a $10,000 federal gift tax annual exclusion, and it was always a $10,000 annual exclusion. It was in 1997 when Congress said, how about if we adjust that annual exclusion for inflation? But Congress kind of did us a solid then. Rather than increasing it every year so that you would have these awkward conversations with clients to say, well, this year your annual exclusion is $10,413. And next year it's $10,612. Instead, no, let's just do it in $1,000 increments as inflation gets big enough to do that. And so as you can see here from the slide, about every 3 to 5 years, we would see another $1,000 that was added to the annual exclusion. Last year, it jumped up to $16,000, but we were expecting that. We were due for that, so it didn't really surprise anybody. What surprised people was that that $16,000 exclusion lasted for all of a single year. And if you remember, I know this is so long ago, In 2022, there was significant inflation, right? When you went to the gas tank and it was $4.95. And when you tried to buy a carton of milk, if you could find one, and it was $5. Holy cow, inflation was out of control. Good thing Congress passed the Inflation Reduction Act. It's such a thing of the past now. We don't have to worry about inflation going forward. Thank you, Congress. But yeah, the 16 went to 17. You know, folks, spoiler, next year it's going to be $18,000 because it was almost $18,000 this year. That's how significant inflation really was in 2022. You want really good illustration of what happened to inflation last year? Look at what happened to the Section 7520 rate. That's right, folks, we're going to start talking code sections. Look around, the accountants in the room are all like, damn, this is getting hot. Here, Section 7520, remember, says that when you have to compute the transfer tax value of an annuity or a life estate or a reversion or a remainder, you have to use the Section 7520 rate as your assumed rate of growth. Section 7520 defines that rate as being 120% of whatever is this month's midterm applicable federal rate of interest, rounded to the nearest 0.2%. When we started in January of last year, that rate was at 1.6%. And even then we were saying, hey, this is starting to grow. You might remember that in the heat of the first wave of the pandemic in the fall of 2020, the 7520 rate hit an all-time historic low of 0.4%. And we always kept wondering, could it go down to 0.2? Could it go down to 0.0? Could it go negative? We were just kind of sitting there and waiting as month after month it was hovering at 0.4, but then it started to tick upward. And we came into 2022 with a 1.6 when in December of 2021, it had been 1.4. And we started saying, uh-oh, we should be getting nervous. But then we thought, wait a minute, it's still 1.6%. That's a ridiculously low rate of interest. By the end of the year, we were more than 3 times that amount. When we hit October of last year and it hit 4.0%, just for context, the last time the 7520 rate began with the number 4 was in September of 2008. And by the end of the year, when we were at 5.2%, we're currently at 5.0% right now. The last time the 7520 rate began with the number 5 was December of 2007. We've been living in a low interest rate environment. We've been practicing as professionals in an estate planning environment for the last 15 years with very low interest rates. As a result, we have been recommending the same strategies over and over and over, because in a very low interest rate environment, there are some strategies that frankly are just incredibly attractive. Short-term grats, where I can put some money with a few commas into a grat that will last for 4 minutes, and I'll pay some huge annuity amount that's coming out. And as long as I can beat the 7520 rate of return, especially when it was like at 0.4%, what do you call a trustee who can't generate 0.4%? Defendant, right? As long as I can beat the 7520 rate, even though actuarially I am told that that trust will have nothing in it and therefore I'm not making a gift. In fact, I will have stuff that's in that. And if I can really beat 0.4%, there can be a few commas in the dollar amount that I'm leaving completely free of transfer tax. In a low interest rate environment, short-term grats are fantastic. What's also fantastic, the other extreme, uber long-term grats. I'm going to create a 99-year grat. You say, that's insane. Of course, you're going to die during the term of that grat. There's going to be estate tax inclusion. Yeah, but the regulations say that what's included in my estate is not necessarily the full fair market value of the assets inside the grat. Read the grat regulations. They say that what's included is the amount necessary to be able to fund the remaining annuity payments. And the way you're supposed to calculate that is take the annuity payment and divide it by the 7520 rate in effect at the date of death. So for liberal arts majors in the room, for who I've completely lost now, if the 7520 rate at death is significantly higher than the 7520 rate at the date you create the zeroed out grat, you end up including a very small fraction of the trust assets in your gross estate. Very little of it is going to end up being subject to estate tax. The lion's share of it passes completely free of transfer tax. It's a simple math game. Are you willing to bet that 7520 rate at death will be higher than it is now? When it was at 0.4%, we had a lot of people that were willing to make that bet. And hell, they can go ahead and die now. They won't usually, but they could go ahead and die now and already be really great. You know what else works well in a low interest rate environment? Charitable lead trusts. Charitable remainder trusts get all the play, right? Because charitable remainder trusts are perfect for your clients with egos that don't fit in this room, because it allows them to get their charitable contribution now. They're also able to defer the income tax, and yet the charity's really not going to get anything until many years down the road. It accelerates all the benefits to them. It defers everything going to the charity. Charitable lead trust, remember, is the opposite of that, where we give the charity the lead interest. But the nice thing is that we can zero out the remainder interest that's going to the non-charitable beneficiary. With low interest rates, it doesn't take a whole lot to be able to zero out that rate, because remember, 75/20 is assuming this trust is forever going to grow at the same 75/20 rate over the next 20 or 30 years. Meaning there's not going to be anything left in the cookie jar if you're paying 5% out to the charity every single year. But in fact, as long as we can beat that 75/20 rate, there will be stuff in that cookie jar, and it all passes completely free of transfer tax. Charitable lead trusts have been fantastic. Installment sales to defective trusts, we're going to talk about them here in a little bit. They've always been great. We've been using them for over a generation. But in a low interest rate environment, these things just became 4-beer attractive and not just 2-beer hot, right? Because the stress that we are putting on the trustee isn't nearly as great when they just have to have a rate of return that's equal to whatever is the midterm AFR if we're just doing a 9-year note. So we've become accustomed to just doing these strategies. We've been using these same arrows over and over again. When you start to run the numbers on short-term grats and on long-term grats and on charitable lead trusts and even on installment sales, you start to sober up. They don't look as hot as they did this time 18 months ago, which has some folks wondering that if interest rates might continue to increase, are we going to have to go back to the 90s? Not entirely, right? I mean, you know, we don't care about presidents playing sax or anything else like that. What we're concerned about is if we go back to a high interest rate environment, are we going to have to use the strategies that we were using back then? Some of you weren't practicing back then. Let me take you back in time. We were doing things called qualified personal residence trusts, or QPERTs at the time. Nobody who doesn't want malpractice has been doing one for the last 15 years because in a low interest rate environment, the numbers just don't work. You can't zero out a QPERT like you can with a GRAP, for example. And so since you're always making a gift, it works really well in a high interest rate environment, but not so well in a low interest rate environment. Might have to come back to that. Charitable gift annuities is a fantastic strategy in a high interest rate environment. Nobody's really been doing them very much, at least not for tax reasons in the course of the last 10 to 15 years, because they don't play as well in that case. The good old charitable remainder trust is a fantastic device in a high interest rate environment because it doesn't take very much to be able to satisfy all the picayune requirements under the statute for minimum amounts that have to be paid to the charity, but not exceeding certain maximums. Much easier to do in a high interest rate environment than it is in a low interest rate environment. Backdoor Roth elections are much more attractive in a high interest rate environment. We're not there yet. When the 75/20 rate, if the 75/20 rate gets to be about 7, 8, 9%, those strategies start to become more attractive again. Right now, we're kind of in this nebulous middle where sometimes the strategies that we've been using still make sense, but in some other cases, maybe it's going to be some of these others. And so we're not at the point yet where we have to be going to seminars with what's a qualified personal residence trust again, and how does this all work out? We're not there yet. But we could be, so we can't exactly be surprised if it ends up happening. With regard to the transfer tax exclusion, of course, everybody here in this room has an exclusion amount of $12,920,000. It'll be over $13 million and change, of course, next year as well. The only thing we know for sure is that if Congress does nothing, which is its specialty, then when we wake up in 2026, we go back to a world where instead of it being a $10 million adjusted for post-2011 inflation exclusion, we go back to a $5 million adjusted for post-2011 inflation exclusion. And what also sunsets at the end of 2025 is the method by which we make inflation adjustments. No longer will we be using something called chained CPI, where we take the consumer price index adjustments and we put a ball and chain around its ankle so that the year-to-year adjustments aren't as aggressive as they normally would be. In 2026, we break free from the chains, Wilson Phillips would say, and we go back to doing the good old-fashioned consumer price index adjustments from year to year. So what does that mean? If it were to come to pass that Congress does nothing, what would the exclusion amount be in 2026? Well, hello, Skippy. That depends upon what happens to inflation and interest rates between now and the end of 2025. And all bets are off on trying to guess that. But still, in the back of our mind, right, we have to be thinking of a number, because if we're sitting down and meeting with a new client or with a new couple, one of the things that we want to gauge is, do they have transfer tax exposure, or will they soon have transfer tax exposure? Because if it comes to pass, some of your clients right now who are statutory PO folk, they will become rich again in 2026. Suddenly they will have to worry about transfer tax when they haven't had to for most of the past decade. Well, in my own mind, I'm thinking of an exclusion that would probably be somewhere in the neighborhood of 7 to 7.5 million per person. 7 to 7.5 million, that is $14 to $15 million per married couple. So if you're sitting down with the married couple that has $8 million, just try not to laugh when they tell you they're wealthy. And just think of how cute they are, that they think that they're rich, when you know there's no way you can F up their estate planning, no matter what, because even the surviving spouse has a big enough exclusion to be able to cover everything, right? So you're like, no malpractice here. What do you want to do? Sure, we'll just do that. But for the married couple that has, 12, 13, 14, they're hovering around the edge, they could go over, well, we got to do a little bit. And then, of course, you're still going to have the big dogs for whom transfer tax exposure and minimization is still going to be something significant. Are we going to see a bunch of people then making gifts at the end of 2025? The longer you're in this profession, do you start to believe that we are living the movie Groundhog Day? Once again, we are saying, uh-oh, there will come a day when the exclusion amount will go down. If you're like me, you've now adopted the viewpoint of, I'll believe it when I see it. Because this is the third time this century you've told me the exclusion amount is going to go down, and it has yet to happen. Actually, it did happen once, right? And that was in 2011. Because in 2010, remember, the exclusion amount was infinity. Because we spent all of the 2000s saying, oh, 2010 will never happen. We'll never have a year in which there is no estate tax, only to have it come back. Oh, please. Congress wouldn't be so irresponsible as to let that happen. And then we woke up in 2010 and it happened, right? Clients were at our door on January 2nd when we reopened the office. Can we kill grandma now? We made it to 2010, we can kill her, right? Because this is the year when there is no tax. But remember the advice we were giving? No, because Congress is going to do something, and if they do, they can make it retroactive back to the start. And remember, we had those discussions about could they do retroactive tax legislation? And of course, they could do retroactive tax legislation. So we said, no, don't do it. Winter became spring, spring faded into summer, summer faded into fall. Can we kill grandma? It's October now. If they were going to do something, it's not going to be retroactive. We're like, yeah. And if you remember, it was on December 17 of 2010, when Congress passed the Tax Relief and Unemployment Insurance Reauthorization and Job Creation Act, which is easy to remember because it had the helpful acronym Chirurgica. Congress passes Chirurgica and says, that's right, kids, there's not going to be an estate tax until next year, but when it comes into effect, it's going to be a $5 million exclusion instead of the $3.5 million that it had been back in 2009 when we last left off. Well, great, except by this point, all the hired assassins were booked through the end of the year. We couldn't get grandma on a holiday cruise to pitch her overboard one night when nobody's looking, so we were stuck with them for a little while. But remember, Chirurgica said this is only for 2 years. After 2 years, it's going to go back. Do you remember when we were going over the fiscal cliff at the end of 2012? Remember when you didn't see any of your family in December because all of your clients were all about hurrying up and using that $5 million exclusion before it went down? We didn't have to reach out to clients. They came to us. help, the Wall Street Journal tells me I have a $5 million exclusion. Well, really, it's 5,120,000. Whatever, they tell me I have this big exclusion and it's going to go down to $1 million. So they say I need to hurry up and use it. So what should I do? What should I do? What's the best thing I could do? And we'd say, well, die. And that's when we realize clients aren't committed to their estate plans, right? No, I have to see how Breaking Bad ends. Yeah, it's the best show ever. All right. So we came up with the next best thing to killing them off. We did the Spousal Lifetime Access Trust, or the SLAT. Remember that? We love our acronyms, don't we? I still wish somebody had come up with Spousal Lifetime Unitrusts. It would have been, I was all set to become the nation's expert on them. I had my Kirkland signature supply of penicillin. I was going to research every one of them in the name of academia, of course. But yeah, so we did SLATs. SLATs, if you've been asleep for the last decade, is effectively a credit shelter trust where you don't have to put a pillow over your spouse's face first. Why wait for a spouse to die before you can shelter assets from appreciation when you can already go ahead and fund a trust for the benefit of the spouse and start sheltering all of that future appreciation right now? That's why we've had SLATs. I maintain SLATs are a great technique, even if you don't think the exclusion amount is going to go down anytime soon. But because that was the only thing that we had, we were going around like these wacky inflatable arm guys at the car dealerships saying, everybody should be doing a SLAT. Hurry up and get your SLATs done. And so everybody was doing the SLATs. And then Congress passes legislation in early 2013 that says, JK, we didn't mean it. The exclusion amount will continue to go on high. And we're like, well, darn it, I'm never going to let that happen again, right? Then we have the election in 2020. Clients reach out to us in December following the results of that election. They're saying, wait a minute, the Democrats are going to be in charge of not one, but two branches of the government. And I know that means that really the puppet masters are Bernie and Liz and AOC. And they're going to reduce the exemption amount to $1.98. And they're going to increase the transfer tax rate to 98%. So I need to hurry up and act now because I anticipate next month there will be a very smooth transition of power. And as a result of that, I need to make sure that I've hurried up and take advantage of this before the amount has gone down. So we're like, SLATs, SLATs, SLATs. That's all you can do in this environment. So we recommended it again because it was going to go down. The Democrats tried. The Democrats don't try really hard, though. Democrats are like 17-year-olds. They think they know what's going on, but they're just not willing to invest the effort behind it. And so rather than use the leverage that they had, they just kind of let it go to waste. And so we end up with the Inflation Reduction Act, which fundamentally altered everything from what it had been before. Nothing really happened. We know nothing's going to happen between now and the next presidential election. And goodness only knows what we have in store for us come 2025. Who knows how we are going to screw ourselves over, but we will find a way to do it one way or the other. And effectively, we're just going to have to wait until the sunset in the end of 2025 before we can really realistically expect that Congress is going to do anything. And what it's going to do is going to depend upon what happens in the election come 2024. So stay tuned at that time. Luckily, though, we do have some guidance. We have some real developments to talk about. The first of them was this revenue ruling that came out in March of this year, Revenue Ruling 2023-2. First thing, it took until March 29 before the service could issue the second revenue ruling of the year. Somebody in the Beltway is pulling down a GS-12 salary to write revenue rulings, and they're only having to do it at about a rate of once every 6 to 8 weeks. I want that job. That's not so bad. But when the IRS said that we are issuing a revenue ruling that talks about what is the basis that a grantor trust has in assets following the death of the grantor, suddenly we spit out our coffee. I know, bourbon, but we'll say coffee. We spit out our coffee and we say, wow, hold on, we're finally going to get an answer. This is one of the great mysteries of life with the use of grantor trusts that we had always pondered and always wondered about, and we were finally going to get guidance. Remember, when you put assets into an irrevocable trust, since you are no longer the owner of those assets do not get a step up in basis for income tax purposes. The reason why you're willing to transfer to an irrevocable trust is usually because you're trying to make a completed gift or completed transfer so as to escape estate taxation. And you are making a trade-off. You are saying, I'm willing to forego a step up in basis if it means I'm not going to pay estate tax on it. We've been comfortable with doing that. One of the strategies that we've been using for the course of the last generation plus now has been doing, instead of making a gift of an asset into the trust, which then uses up some of my $12.92 million exclusion, I will instead sell property to the trust so that I'm not using any of my exclusion. And as long as I structure this as a grantor trust for income tax purposes, I am selling to myself. And we all know that Revenue Ruling 8513, because every morning we get up, we unroll our prayer mats, we get on our knees, and we face toward Treasury, and we bless and thank Treasury for the gift that it gave to us of Revenue Ruling 8513. Because that revenue ruling says that transactions between a grantor and a grantor trust are disregarded because the grantor is already the deemed owner of everything in the grantor trust for income tax purposes. And so, says the ruling, in effect, when you transact with your grantor trust, you are transacting with yourself. And as you learned in high school health, that's perfectly normal, perfectly healthy. We just have this thing that just says, let's not talk about it. Let's not put it on a return. We'll all just say, clean up after yourself and let us never speak of it again, right? So Revenue Ruling 8513 says you don't recognize any gain upon the sale. So then, of course, we have the defective grantor trust because some idiot was in charge of naming this thing. The defective grantor trust is the trust that is a grantor trust for income tax purposes, so we get to sell with no gain, but it counts as a transfer outside the estate. It is not a grantor trust for transfer tax purposes, so the assets will not be subject to estate tax when they die, okay? Whoever came up with it called it a defective trust. That's awful because that's not what it is. It is the best of all worlds. Some of us still will recommend to a client, I think you should do a defective trust. And we kind of watch them as they look back at us and say, really? Your advice is to do a defective trust? And we say, yeah, and I want you to have crummy powers in it too. You're like, huh, all right, fine. Some of us, to make a client feel better, we call it an intentionally defective grantor trust. Let me tell you, that doesn't exactly build any trust going there with the client either, right? But no matter what it is that you want to call it, that's what's been happening. Here's the great mystery that we've never known. If I transfer the asset into a defective grantor trust and then I die, does the trust get a step up in basis, or what basis does the trust have in the assets? And we know that the answer is one of three things. It's kind of like, let's make a deal. There's curtain number one, curtain number two, curtain number three. Curtain number one, the Internal Revenue Code under section 1012 says that unless another rule applies, your basis is cost. When a trust pays a promissory note back to the grantor to purchase an asset, then it should take as the basis in that asset the face value of the promissory note. So if what we are selling is $2 million worth of asset in exchange for a $2 million note, the trust should have a $2 million cost basis. That's curtain number one. Curtain number two, though, says, wait a minute, for income tax purposes, there is no transfer until the grantor dies. Because there's no transfer until, once the grantor dies, the trust can't be a grantor trust, because the trust survives, the grantor does not. The trust becomes a separate taxable entity. We all know that. We all accept that. Well, then, if there is no transfer until death, shouldn't it get a step up in basis equal to the fair market value of the property on the date of death under section 1014? And then there's curtain number three, which says curtain number two sounds nice until you learn to read the code, because the code contains a special rule just for this situation in section 1015B. 1015A says that if you receive an inter vivos gift from a transferor, you take their basis in the property for purposes of determining gain. So not only do you have to write a thank you note, but you also have to ask them, how much did you pay for this property? Because that's going to now become my basis in this property going forward. But section 1015B, the lesser read provision, says that in the case of a non-gift transfer in trust, the trust takes the grantor's basis in the property. It's a carryover basis. It is not a cost basis. It's not fair market value date of death. It is what is the grantor's basis in that case. Well, there's been this great debate among all the commentators, but there's never been authority. There's never been anything that we could cite before. A handful of people will argue for cost basis. 2 prominent commentators argue for fair market value. And the rest of the world says, yeah, but how do you deal with 1015B, which seems to be pretty on point, and say that you have a carryover basis in that case. When the IRS says we're going to give you a ruling, we're like, ha, we can at least now know what the IRS's position is as regards to which curtain it is. So without further ado, the holding of the ruling. If A funds T with asset in a transaction that is a completed gift for gift tax purposes, the basis of asset is not adjusted to its fair market value on the date of A's death under section 1014 because asset was not acquired or passed from a decedent as defined in 1014B. Accordingly, under this revenue rulings facts, the basis of asset immediately after A's death is the same as the basis of asset immediately prior to A's death. If you read it in a hurry, you think that they are choosing curtain number 3, but read it slowly. If A funds T with asset in a transaction that is a completed gift for gift tax purposes, this ruling isn't about what basis does a trust take when it purchases property. It talks about what basis does a trust take when it is gifted property. Well, no excrement, Sherlock. We already knew that when you make a gift of property into an irrevocable trust, there is no step up in basis because of that trade-off that we talked about before. We already knew this. The service is issuing a revenue ruling that breaks absolutely no ground, right? Hey, there's a sun that rises in the east. This just in. From the folks at the IRS, it doesn't, but then it goes on, right? Accordingly, under this revenue rulings facts, the basis of assets immediately after A's death is the same as the basis of asset immediately prior to A's death. Notice it doesn't say it is A's basis in the property, right? Instead, it says it is the basis immediately prior to A's death. Why does it phrase it that way? Instead of just saying it's whatever A's basis was at the time of death. It strikes me that the reason why it might say that is to reflect that, well, maybe what that's getting at is if between the date of gift and the date of death, there are improvements that are made to the property, those improvements would be added to the basis of the property and therefore would count. And you would not lose credit for it in that case. But the service doesn't really explain that that's what it's saying, so that's just a guess. But then, when it also uses that language, it makes me think of something that I don't think we'd ever thought about before. There's a relatively obscure provision in section 1015, the carryover basis rule. It's 1015D6 for the CPAs in the room that want to go home and check it out on Google. Well, okay, for gift tax purposes, 1015D6 says, if you make a gift so large that you pay federal gift tax on the transfer, the donee of the gifted property gets to add to the carryover basis a portion of the gift tax that was paid by the donor. You get basis credit for gift tax paid by a donor. So now I invite you to think about this hypothetical, because nobody ever thought about this before, because this doesn't really happen a whole heck of a lot. But now that they use this language, it's making us wonder. Suppose that that transfer was a $50 million gift. Even with a $12.92 million exclusion, we're going to pay some gift tax on that transfer. Does the trust get to increase the basis of the asset by a portion of the gift tax that was paid by the donor? And what if the trust sells the asset before the donor dies? We don't know the answer to either of those questions. So good on you, IRS. Instead of answering the one question we needed an answer to, not only did you not answer that, but you also raised 2 more questions that we hadn't even thought about before until just now with the wording that is there. We are hopeful that this is the beginning of a trilogy, and that at some point we're going to get more guidance as to, okay, well, what if it's not a gift transfer? What if it's a sale transfer? Because that's the one we want to know about. But in the meantime, we're left with guidance that raises more questions than it solves. Mission accomplished? We don't know. Want to see an interesting case that might make some of us in the room tremble a little bit? We had a decision that came out of the 8th Circuit this summer that deals with a corporation that had acquired life insurance on the life of its shareholders to fund a buy-sell agreement. While we have pretty settled precedent here within the 11th Circuit, this was a case of first impression to the 8th Circuit, and it reached the opposite conclusion. The case is Estate of Connolly. It involved a company that was a materials corporation that was owned by two brothers, Michael and Thomas. Michael owned 77%, Thomas owned 23%. The two brothers entered into a buy-sell agreement that provided that on the death of the first brother to die, the other one would be given a right to buy out the shares of the other. And if the brother chooses not to exercise that right of purchase, then the corporation is required to redeem out the deceased shareholder's shares so that in all events, the surviving brother will own 100% of the stock. Well, apparently everybody stipulates that both Michael and Thomas had it in mind that neither one of them were going to buy the stock of the other. It was going to be the corporation. And so in that connection, the corporation went out and it bought a $3.5 million life insurance policy on the life of each brother. Well, Michael, the 77% owner, was the first one to die. And the corporation got the $3.5 million of proceeds. That meant Thomas was now in charge of those proceeds as the sole owner of the company. Thomas also happened to be the executor of Michael's estate. Conflict of interest much? And so how much was going to be paid to Michael's estate? Well, the buy-sell agreement said that the purchase price would be based upon a formula that the shareholders would agree to annually. They never did that. They never reached an agreement as to what the formula was going to be used. But the buy-sell agreement contained a backup and said that if the brothers don't come to a meeting of the minds as to the right formula to use, then we will use the average of 2 or more appraisals of the stock that are obtained immediately following death. They never went out and got appraisals of the stock from any appraiser either. Instead, surviving brother Thomas negotiates with Michael's eldest child, and they together mutually agree that the company is going to use $3 million of the $3.5 million to buy out Michael's shares. The other $500,000 of death benefit was going to stay inside the company. What we're talking about in this case is how do we value Michael's 77% interest in the company? And the IRS says, we think that in valuing his shares, we need to take into account 77% of the death benefit under that life insurance policy. Here in the 11th Circuit, we say, well, that's not true. In the 11th Circuit, we have the Estate of Blunt case that back in 2005 said, no, corporate-owned life insurance does not increase the estate tax value of stock, because even though corporate-owned life insurance is an asset, it is immediately offset by a liability. Any death benefit that it receives, it's going to have to turn around and pay out to the shareholder, so there's no net wealth that's there. They cancel each other out. Corporate-owned life insurance does not affect estate tax value of the stock. To which the 8th Circuit says, I want to smoke what you're smoking, because that just ain't right. You're telling me that if somebody on the eve of the death of Michael was going to sell Michael's shares, they would not factor in that this company was about to come into an additional $3.5 million worth of wealth through a death benefit and figuring out the price at which they were going to sell that 77% to an unrelated buyer? Oh, hell yes, a seller would take that into account. So you can't really say that the company's only worth $3 million when there's going to be 77% of a $3.5 million policy together with the value of the company that's coming with it. So the 8th Circuit holds exactly the opposite of the 11th Circuit in Estate of Blunt, and that has set up a conflict among the circuits. The Estate of Connolly, having lost in the 8th Circuit, has petitioned the U.S. Supreme Court for review of this decision. So we will see if the Supreme Court grants cert and decides to issue a consistent opinion. One kind of gets the feeling that maybe they won't issue a cert petition, and we'll talk about why we feel that might be the case coming up here in a little bit. In fact, it kind of has to stem from this. If you're a little bummed that it's starting to look bad for taxpayers over here, we are about to talk about now how the last 12 to 15 months have been absolutely the worst for the IRS. It has been a terrible, horrible, no good, very bad year for the IRS. Why? Because it is finding out consistently from courts that it is routinely violating the Administrative Procedure Act. That's right, folks. You came to a presentation tonight that was about tax law, but we're also going to talk a little administrative law too. I know you paid for the whole seat, but you only need the edge. Wind up, because here we go. For a little bit of statutory context, back in 2004, Congress added Section 6707 Cap A to the code, which says that if a taxpayer engages in a reportable transaction or in a listed transaction, the taxpayer must disclose certain information about that transaction when the taxpayer files an income tax return. And if the taxpayer fails to provide that information, there will be monetary penalties ranging from $5,000 up to $100,000 in the case of willful failures to file. What's going on here? Well, Treasury over the years has come to realize that there are certain transactions that taxpayers will engage in, which might be perfectly legitimate, but which could also be used for nefarious purposes of tax evasion. So when a taxpayer engages in one of those transactions that triggers the IRS and thinks, what's going on here? 6707 Cap A is giving the IRS additional information about that transaction so they can either decide, oh, okay, this one's a legit transaction, it's fine, or, oh, we want to look into that one a little bit more. Combine that with Section 6662 Cap A, which says that if you engage in a reportable transaction or in a listed transaction, and that transaction ends up causing an understatement of tax, that in addition to the normal 20% penalty that applies to understatements, you'll owe an additional 20% penalty. And if you went to public school like me, that means that's a 40% penalty that you are having to pay in that case instead of the usual 20%. So a big deal then becomes, what's a reportable transaction? In both cases, the statute says reportable transactions, listed transactions, will be those as identified by the IRS in published guidance. The IRS gets to identify and announce what are reportable transactions. When it does, there are reporting obligations and there's risk of additional penalties. So what has the IRS done since 2004? It has identified reportable transactions and listed transactions by publishing notices. Hear ye, says the IRS. The following is now a listed transaction. If you engage in that transaction, you need to disclose it. And if it results in an understatement, whammo, there's going to be another penalty. It's been doing that routinely. For example, in Notice 2007-83, the IRS announced that if you have an employee benefit plan that owns cash value life insurance on the lives of plan participants, that is a listed transaction, because while that might be perfectly innocent and appropriate, we are aware of schemes that people are using to convert taxable compensation into non-taxable insurance death benefit. And so we want to be able to police that. Well, up in Michigan, there's a couple of fellows who own a construction company. They have a employee benefit plan that covers just the two of them. And sure enough, the employee benefit plan owns a cash value life policy on each of the two owners. When the IRS was auditing the corporation over something completely unrelated, it tumbled onto this information about the plan and said, wait a minute, you didn't disclose that information. They faced penalties, the corporation faced penalties, they totaled $26,000. The corporation paid the $26,000 of penalties and sued for refund, going to district court to argue, well, we think that our plan is not exactly within the scope of the notice. But their opening salvo was, Your Honor, we think that that notice is invalid. And the reason why the notice is invalid is because it wasn't first issued in proposed form like the Administrative Procedure Act requires. You see, the Administrative Procedure Act says that before Treasury or any federal agency can make new law, they must first issue it in proposed form. That's why we get proposed regulations before the regulations are finalized, because the Administrative Procedure Act says first you have to propose them, you have to solicit comments from the general public, you have to then consider those comments, and only then can you write final regulations. But even the final regulations have to come along with a preamble that explains, here's all the comments that we got, and why we made some changes and why we didn't make some other changes. And then you have a valid regulation. Taxpayer says, well, they didn't do that with this notice. They just said, from now on, this is a listed transaction. It didn't come out in proposed form, so it's void under the APA. And the IRS kind of quietly giggles to itself. They don't understand the difference between regulations and notices. The IRS says, yeah, when it's a regulation, we have to do proposed and comments and all that stuff. But when it's a notice, we don't have to do that. The statute says we get to identify the transactions in published guidance, and we're doing that as we have been doing it for decades in this and in all other contexts in the form of a notice. Of course, we don't have to first issue it in proposed form. And yet, the Eastern District of Michigan held, you are making a new rule when you identify this as a listed transaction. And the APA is pretty clear that when you make a new rule, it has to first come out in proposed form, which this did not. So we think that that notice is invalid and that therefore the taxpayers were not engaged in a listed transaction because that's an invalid way to say it is now a listed transaction. The IRS then thinks, oh my. Every single listed transaction, every single reportable transaction has been identified by a notice. If this district court judge, Judge Rando here, is right, that that notice is invalid because it wasn't first issued in proposed form, then none of the identified listed transactions are enforceable because none of them have been issued in proposed form. Two, we better take this up on appeal. So they take it up on appeal, and the Sixth Circuit says, nope, the district court got it right. It had to first come out in proposed form. It didn't, therefore it's invalid. Remand it back to the district court with appropriate instructions. Before then, the IRS says, well then, let's just make sure that we're only talking about this taxpayer and not all taxpayers. But then the district court in January of this year says, no, when we say it's invalid, we're saying it's invalid as to everybody, not just to the two guys in Michigan who were the ones to raise this successful argument. So notice 2007-83, it's void. But if that's right, then isn't every notice void? And if that's right, then isn't every notice, even beyond the context of reportable and listed transactions, isn't every IRS notice that has ever been issued that contains a new rule, because it didn't first come out in proposed form, it is void? Oh, this is a one-off. No other court would hold that. In notice 2006-66, the IRS said that micro-captive insurance arrangements are a listed transaction. I can read your faces. Please, please, please spend the next 20 minutes talking about micro-captive insurance arrangements. Please, 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 please. Sorry, we have other things to talk about. They identified micro-captives as listed arrangements, and an Eastern District in Tennessee in March of last year holds that here too, it was not first issued in proposed form. It is invalid. The IRS then says, well then, if we want this to be a valid listed transaction, if we want to capture micro-captives, what do we have to do? We have to issue it in proposed form. So in April of this year, out came proposed regulation 1.6011-10 that said micro-captive insurance arrangements are listed transactions. Please submit comments promptly because we're finalizing this thing fast. Okay? They're learning their lesson, aren't they? And they're starting to realize, uh-oh, in all of these, we need to start reissuing them as proposed regulations. But, Eastern District of Tennessee, the other one was Michigan. Those are both in the Sixth Circuit. Maybe this is just a Sixth Circuit thing, and outside the Sixth Circuit, we don't have to worry about it. In notice 2017-10, the IRS said that syndicated conservation easement transactions are listed transactions. What's a syndicated conservation easement transaction? What a lot of your clients have been doing. That's where rich people get together and they form a syndicate. What's a syndicate? It's a group that won't let you in it. And so you don't like it, so you call it a syndicate instead of a hang. Right? If they would let you join in. Syndicated conservation easement is when rich people form an LLC. The LLC goes out and it buys raw land somewhere where they can get large tracts of land for the sole purpose of slapping a conservation easement on the property. They will then take the position that the value of that easement is so large that the corresponding income tax deduction that flows through from the LLC to the owners far exceeds their initial investment in the land. So then the LLC just sells the land, and frankly, it sells the land for next to nothing, because now that the existing use of the property can never be changed, you have substantially impaired the fair market value. But the owners don't care because they already have an income tax savings that is greater than the amount that they have invested. In fact, the people that are promoting these transactions guarantee that you will get an income tax deduction that will save you tax at least 2.5 times the size of your original investment. And if you don't, your money back. That's how successful these things have been. The IRS has said, we think there's some shenanigans afoot, so we're going to identify it as a listed transaction. But it wasn't first in proposed form. So then when a LLC along with 3 others acquired some land, slapped a conservation easement on it, and claimed a $22.5 million deduction times 4, the IRS goes and attacks the conservation easement, and they say, well, if we do owe a penalty, we don't owe the second penalty because that notice is valid. And in a 15-2 decision last November, excuse me, the tax court holds that, in fact, the notice is invalid. It has to be set aside. And since then, we've had federal district courts in Alabama and Ohio echo that same result. Where are we now? If the IRS issues a notice, read it. If you like it, if it's taxpayer friendly, follow it. But if you don't like it, it contains a rule that you don't like. We have just talked about 6 cases, all decided within the last 15, 16 months, that say that notice is invalid because it wasn't first issued in proposed form. No notice ever written by the IRS is valid, not one of them. Oh, somewhere in this favored land, the sun is shining bright. The band is playing somewhere, and somewhere hearts are light, and somewhere folks are laughing, and somewhere children shout. But there is no joy at Treasury. Every notice has struck out. Nice try. Still got 20 more minutes. Now, speaking of conservation easements, by show of hands, how many of you have had a client that has done a conservation easement? I mean, these things are fantastic, right? The IRS has been policing them, not just on the syndicated conservation easement front, but we should talk about how Treasury and Congress responded to Green Valley investors. Shortly after Green Valley investors came out, the IRS issues proposed regulation 1.6011-9 that says syndicated conservation easement transactions are listed transactions. Please give us comment because we're going to be finalizing this regulation soon. They're not going to finalize this regulation soon. Why? Because Congress changed the statute. As a revenue raiser for Secure 2.0, which we're about to talk about, Congress created new Section 170H7. And 170H7 says if you participate in a syndicated conservation easement transaction, you get a deduction of 0. Well, that solves the problem. We don't need to police it anymore. If the IRS says from date of enactment now that doesn't work and you get a deduction of 0, we don't need to police it much because there's no reason now to engage. If somebody approaches you today about doing a syndicated conservation easement, it's like, bro, where were you a year ago? Now it's too late. We can't do it because the time has already passed. An interesting other provision that was inside of Secure 2.0, though, was this rule that instructed the IRS to issue safe harbor deed language that would give taxpayers assurance that if they did a conservation easement transaction and if they used the language provided by the IRS, that the IRS will not challenge the validity of the deed when it comes to the perpetuity requirement. Because that's been the thing that the IRS has been using as a silver bullet lately, as we'll talk about in greater detail. Well, the IRS followed through on that in April of this year in Notice 2023-30. Now, this notice is helpful to taxpayers, so we follow it, okay? It's valid. This notice contains safe harbor deed language, so if you have a client who's going to do a conservation easement, you're a fool not to use this language in your deed. That's right, fool, if you don't use that language. What was a nice benefit, but it has already expired, The Secure 2.0 Act provided that if a taxpayer with an existing conservation easement filed a correction deed within 90 days of that notice being published, it would be made retroactive back to the date of original contribution, and you would be immune even as regards to pre-existing conservation easements. Well, that deadline passed in July of this year, so unless you're unethical, it is now too late to take advantage of that retroactive effect. But at least going forward, we know we have form language that we're supposed to use. What was this thing about perpetuity? It all stemmed from the so-called proceeds regulation that says in the unlikely event the conservation easement purpose can no longer be fulfilled and a court orders an extinguishment of the easement, if there is a subsequent sale of the property, the charity has to be given a share of the proceeds at least equal to the proportionate value of its easement. So if, for example, I own a $100,000 parcel and I donate a conservation easement that is worth $20,000, that's 20%. So if at some point in the future the property is sold, the charity has to get 20% of the proceeds, right? Well, everybody has a conservation easement deed that provides that. But here's the thing. What people have that everybody uses, the same language that everybody has copied, is based off of an old private letter ruling where a taxpayer said, this is the language we want to use in our deed and we want to make sure it works. And the IRS says, well, you paid for this ruling, right? Yeah. Did the check clear? Yeah. Then okay, yeah, this deed works. Right? That's how private rulings work. It's kind of like the church. As long as the money gets donated, you're absolved of the sin. They made their donation, they got their favorable ruling, so everybody uses that language. What's in that language that everybody follows that was blessed by Treasury and the PLR is a provision that says, well, if there's a sale, first you reimburse the donor for the cost of any improvements that have been made to the property by the donor, and then you split the net proceeds. Well, the tax court and the Fifth Circuit both came down with rulings that said, that regulation requires that the charity has to get a cut of the gross proceeds, not of the net proceeds. And because deeds contained language that only gave charities a share of the net proceeds, the IRS was able to argue that they failed the perpetuity requirement and therefore got an income tax deduction of 0. No longer did the IRS have to argue valuation in a conservation easement. It could just say they get a deduction of 0 because they used the wrong language. Language that we said in a private ruling worked. Remember, private rulings cannot be cited as precedent. They don't bind the IRS as to anyone other than the taxpayer who asked. So just like your spouse, the IRS has changed its mind. And it doesn't have to have a reason for doing so. It says we think differently. And once the IRS tumbled to that, they won and they won and they won. In fact, after winning their first case in that, just a little over 4 years ago, the IRS went 20-0 in tax court on that argument. That is a streak that rivals the Undertaker, my friend. 20-0 that it went, not losing on that argument until they tried it in the 11th Circuit, right? When the Hewitt case here in the 11th Circuit said, we think that that regulation is invalid. How could that regulation be invalid? Wait a minute, this was issued in proposed form. And we solicited notice and comment on here. Come on now, this regulation is valid. The 11th Circuit says, no, because the APA says that you have to consider comments. And the 11th Circuit identified that there were 6 different organizations that submitted comments on the proceeds regulation. And yet, the final regs are to the comma, the same that they were in the proposed regulation. And there is no mention of those comments in the preamble. So the 11th Circuit says, look, you had one job, and that was to explain why you were not making the changes that were requested by these 6 organizations. And when you fail to do that, you violate the APA, and the consequence of violating the Administrative Procedure Act is your regulation is invalid. The Hewitts get their deduction. Interestingly, when the same set of facts was presented by the same advocate, fresh off of winning Hewitt, represents another taxpayer in the 6th Circuit. The 6th Circuit, in a case called Oakbrook Land Holdings, decides, no, we think the regulation is valid. The 6th Circuit opinion is kind of worth downloading because this is fun. The 6th Circuit actually goes through each comment one by one, identifying the organization that submitted the comment, and then explaining one by one why that comment was either stupid or irrelevant. Before the Sixth Circuit finally says, look, Treasury doesn't have to respond to every wackadoodle comment that is submitted by some rando. They only have to respond to the germane comments, not to the Tito and Latoya comments, just to the germane comments. That was funnier than you gave it credit for, but I'm blaming pasta and wine for the slow pickup on that. So watch the recording later. That was funny. Anyway, Sixth Circuit says we think the regulation is valid. Okay, I think we can all agree, regardless of which position you think is right. I think we should all agree that whether that regulation is valid should not depend upon whether you are in Florida, Georgia, and Alabama, or if you are in Tennessee, Ohio, and Kentucky and Michigan, right? I mean, it ought to be the same for all taxpayers. So upon losing, the taxpayer in Oak Brook petitioned the U.S. Supreme Court for cert, kind of like what the estate of Connolly has done. But in January of this year, the Supreme Court said, we don't like to decide controversial cases. That's not this current Supreme Court at all. No. And it did not grant cert. We're stuck with that split that's happening. We could see the same thing happen in the Connolly case with respect to corporate-owned life insurance as well. At least in both cases, we live in taxpayer-friendly jurisdictions as far as they've decided it. We're not done with the Supreme Court yet, but before we get to them, let's talk, since we've already alluded to Secure 2.0. You'll remember that passed as part of the big Consolidated Act in December of last year, Secure 2.0 comes out that makes a number of interesting changes. The only ones that we'll focus on here really quickly, lower left-hand corner, starting this year, a terminally ill individual can withdraw any amount, no limitation, can withdraw any amount from their defined contribution plan or from an individual retirement account, and they do not have to pay the 10% penalty if they are doing so before they've reached the magic age of withdrawal. So if you're terminally ill, you can pull money out of your IRA. If it's a traditional IRA, it might still be taxable income, but you're not going to pay the 10% penalty on top of it. What's really interesting about that provision, though, is how it defines terminally ill. For virtually every other position regarding terminally ill individuals, it's, do you have a greater than 50% chance of dying in the next 1 year or 2 years? Under this statute, you are terminally ill if there's a greater than 50% chance you might die in the next 7 years. I think I might be terminally ill under that definition. I'm not currently having any problems, but a lot can happen in 7 years. Am I right? So that's going to be interesting to see how that one unfolds. Starting next year, if you have an emergency, which the statute defines as an emergency, then you can withdraw up to $1,000 from your retirement plan. It might still be gross income, but you won't pay the 10% penalty. Now, you can only have an emergency once every 3 years. But if you repay the $1,000 that you pulled out for an emergency, right? Like, I need a Coke hit. I got to get an 8-ball. Let me pull $1,000 out of my account, or whatever. I don't know. I don't do these things. That kind of hurt. Then if I repay the $1,000, I get a brand new 3-year clock, and I can turn right around and have another emergency, and I'll be okay as long as I'm repenting for it. And then starting next year too, domestic abuse victims are allowed to withdraw up to $10,000 on a one-time basis from a defined contribution or IRA without paying the extra 10% penalty. That's going to be awkward for some of individuals who would benefit from that provisions to be able to do that given the nature of the relationship. So it's going to be very interesting to see how that ends up unfolding. We'll have to stay tuned for further developments. Top right-hand portion. If you have an old 529 plan, that is one that's been around for more than 15 years, and the kid got the associate's degree and said, mic drop, I'm out, and you still got some money sitting inside of that 529 plan, what the hell are you supposed to do with that? Thanks to Secure 2.0, you can roll over up to $35,000 directly into an IRA for the benefit of that kid. Since they have the associate's degree, let's do what we can to give them an income stream. Okay? So if you have leftovers in a 529 plan, we got a place for them now. That's kind of cool. We also kind of wondered a little bit. We knew that if you had a special needs trust that was the beneficiary of an IRA or retirement plan, that you could use the life of the special needs beneficiary and still get a lifetime stretch out because they're still eligible designated beneficiaries. What we didn't know is if that special needs trust provides upon the death of that special needs beneficiary, what happens to the remainder? Since the remainder is not going to go to an eligible designated beneficiary, the proposed regulations under Secure 1.0 said that you can't do a lifetime stretch out. Secure 2.0 says as long as you name a charity as the remainder beneficiary, you still can. And it will work and you can still do the lifetime stretch out. That's nice. And then remember, for a number of years now, we've had charitable rollovers where you can have up to $100,000 that goes directly from the custodian to the charity and it counts as your RMD, but you don't have to take it in gross income at all. At long last, starting next year, that number of 100,000, that limit is going to be indexed for inflation. So for the clients that have buku amounts sitting inside the IRA and they've been hitting that $100,000 ceiling every year, they're now going to be able to bust through that ceiling starting next year. While we're talking about Secure Act, you'll remember that the original Secure Act, the OG of the Secure Acts, provided that the only people who can do lifetime stretch outs now are eligible designated beneficiaries. And we had proposed regulations that came out that was trying to explain how that new rule would work. But there was a surprise in those proposed regulations. This was in February of 2022 that said that if the participant had started taking required minimum distributions before death, we knew that if you named an adult child as the beneficiary, that there was going to be a 10-year payout instead of a lifetime stretch out. We all understood that. But we thought the 10-year rule was going to work like the 5-year rule and that I could just wait until the end of the 10th year and take it all out then. Surprise, say the proposed regulations. In fact, you have to take minimum distributions each year over that 10-year period. Holy crow. What do I do about the decedent, the participant who died in 2020? We were supposed to take minimum distributions in 2021 and we didn't. We were supposed to take a minimum distribution in 2022. We haven't. And there's a penalty of 50% if you fail to take the minimum distributions. Do we owe these penalties? Well, you might remember that in October of last year, the IRS issues Notice 2022-53. This is a good notice, so we follow it. 2022-53 that said, we will not impose penalties for failures to make minimum distributions in 2021 or 2022 because the regs aren't going to be finalized until 2023 at the earliest. In July of this year, the IRS issues Notice 2023-54, which says, yeah, it's going to be next year too. So you don't have to make a minimum distribution this year either. But in effect, the service is signaling to you, these regs are going to get finalized likely next year, and you will have to start taking minimum distributions. How that's going to work? Stay tuned. We'll find out. We're going to end things today by talking a little bit about foreign bank accounts. You all remember that under the Bank Secrecy Act of 1970, if you have more than $10,000 on deposit with a foreign bank, you must file what is called a report of foreign bank and financial accounts, which to bankers is known as an FBAR. Proof that bankers don't know how an acronym works, right? Because it should be called a RIFBFA, but instead they call it an FBAR. I think they call it an FBAR because it kind of sounds like FUBAR, which is what your client will be if they do not file this. Because the Bank Secrecy Act contains some pretty nasty provisions. If you negligently fail to file an FBAR, you will pay a penalty of $10,000 per violation. And if it is a willful failure to file, the current version of the Bank Secrecy Act says that that penalty increases to the greater of $100,000 or 50% of the balance on deposit in foreign banks. Suddenly, if you have $1 million Swiss bank account, you'd be looking at a $500,000 penalty for failing to disclose the existence of that account. And this is an annual requirement that you have to file. Well, the Supreme Court in February of this year announced the decision in Bittner versus United States, which we were paying attention to. The Bittner case arose out of the Fifth Circuit, which involved an individual who was a naturalized United States citizen, born in Romania, but became a US citizen, goes back to Romania for a 5-year period and engages in all kinds of business activities in Europe using dozens of bank accounts located in lots of different European countries. But because he's now a naturalized US citizen, he has the obligation to be filing these FBARs, which he didn't know that he was supposed to. It wasn't until he came back to the United States and was meeting with his advisors when his advisors say, well, you've been filing FBARs, right? And he's like, what is this FBAR? That's the worst Romanian accent you're ever going to hear. But he said, you know, what is this FBAR that I have to file? I have to do what? And they said, drop everything. You got to file these right now. And so effectively, Bittner throws himself on the mercy of the service, which administers the penalties here, and just says, I didn't know, this was not a willful failure to file. I didn't file for 5 years. So that's 1, 2, 3, 4, that's 5 violations. I guess I owe a $50,000 penalty. And the IRS said, that's not how it works. You see, each account was supposed to be disclosed. And your failure to disclose each account was a separate violation for each account. Multiply that by the 5 years of not reporting each of those accounts, you committed 272 violations, and the penalty that you owe is now $2,720,000, not $50,000. So right away, Bittner goes running to the Fifth Circuit. Bittner, you know, goes to Fifth Circuit saying, help, I can't afford, that can't be right. I didn't willfully mean to do it. Please tell me that the penalty only applies per form as opposed to per account. To which the Fifth Circuit said, you talk funny. You're not from here, are you? To which he said, well, I'm a naturalized U.S. Aha, I didn't think you were from here. You're a foreigner. No, it applies per account. You owe $2.72 million. That was completely in contravention of the Ninth Circuit, which had said on these same facts, it would only be 5 violations. How weird is this? The Ninth Circuit was pro-taxpayer. The Fifth Circuit was pro-government. They forgot their roles and how they're supposed to work, but that's how it came out. U.S. Supreme Court grants cert because they have to put an answer to this. And get this, it's a 5-4 decision from the Supremes. And look who's in the majority. Justice Gorsuch writes the opinion for the majority, joined by Justice Roberts, Alito, and Kavanaugh. Okay, that's the frat boys, along with KBJ. Did someone not tell her what's going on here? The majority, 5-4, says we think there's only 5 violations here and not 272 of them. Why? Well, because the Bank Secrecy Act itself talks about a duty to file reports. That's an FBAR form. That's not a duty to disclose accounts. It's a duty to file reports. Since the duty is to file reports, we think the penalty applies per report. Furthermore, the IRS's instructions simply mention that the failure to file will result in a civil penalty not to exceed $10,000. If the idea was supposed to be it's $10,000 per account, the instructions to the form would say that and would indicate that that was the case. So we think that that ought not be held against the taxpayer in this case. And besides, you're telling me that Bittner owes a $2.72 million penalty for disclosing as soon as he became aware of it, but somebody who willfully hides an account is only going to pay $100,000 if they're just lucky enough to have a single account? It ought not be that the negligent filer pays a higher penalty than the willful one who does not file. So we think for all those reasons, it ought to apply per form. So who's in the dissent? Justice Barrett, writing the dissenting opinion, joined by Justice Thomas so that he didn't have to do anything, and then joined too by Justices Sotomayor and Kagan. What the heck? Is this a key party going on in here? I mean, where's the 6-3 supermajority split? This is not a political issue at all, friends. This is strictly a statutory interpretation issue. And according to Justice Barrett, hold on, the Bank Secrecy Act says that you have to, sure, it only speaks of an obligation to file a report, but you have an obligation to file a report when you maintain a relation with a foreign bank. What's a relation with a bank? It's an account. What you have the obligation then to disclose, she says, is really accounts and not just the form. Furthermore, there is a reasonable cause exception to the invocation of the penalty, but you only qualify for it if you have promptly disclosed the balance in the account. Proof that what we're really interested in is information about the account and not just a filing of the form. She says that the majority has confused the reference to report in the statute with the FBAR form. She says, we think that the FBAR form contains multiple reports. Each account is a reporting. They're just all contained on a single form. Report does not equal form. So it's kind of rare to see a split among the justices that isn't along predictable partisan lines where you know in advance how it's going to turn out. It's a 5-4 decision, but it ultimately ends up being a favorable one. We also had some cases that came out of Oregon and Michigan this year that said when you have advisors that are regularly telling you file, 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 and you say, nah, 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 that does rise to the level of willful failure to file. Aren't you glad you came to a presentation here tonight so that you knew that that would constitute a willful failure to file? Thank goodness we have federal court decisions that are talking about all of that. If we'd had time, we would have talked a little bit about Florida Victorious as well. I guess I shouldn't. I went to Florida. I got my LLM at Florida. I should have been fair. Are there any grads here from Florida State? I'm sorry, I've been speaking way too fast for you, haven't I? That's my bad. I should have asked in advance, but my bad. If you are making a donation to an NIL collective, don't take a charitable contribution deduction for it because it's really about helping the student athlete be able to generate money off of their name, image, and likeness. And even though theoretically they are having the athlete go and perform services for a charity, it's not tax deductible. The IRS made that clear in Advice Memorandum 2023-4. We've apparently redesigned how we cite to technical advice memoranda going forward. If we'd had a little bit more time, there'd even be a couple of other fun cases that are in there too. But the most important thing, I'm a state employee, and under the Georgia State Constitution, I'm not allowed to work overtime unless I had advance permission from the governor, which I did not secure before coming on my flight here today. Thank you very much for your patience in being here. I hope you'll continue to come to this series going forward, and I hope to see you down the road. You need me to fast forward to the thank you slide, right?
Thank you.
See all the things we could have talked about?
Yes,
I know. Oh, it would have been awesome.
that would have been great. Thank
There you
you,
go.
Sam.
Yeah,
As
you bet.
always, excellent, excellent.
As
Well,
always, this is my
as
first
always.
one.
I've seen you so many
Oh,
times.
okay.
It's always good. We knew you would deliver. So
Thank you for
so
pretending the
much.
jokes were new.
Yes.
It was nice of you.
Excellent. Well, I'm Sheila Kimman with the Community Foundation. I just have some quick final instructions before we dismiss tonight. First off, as it was mentioned, you will get a email from us, and it's important to not ignore that because it's going to have the attendance of record information in there. Let's see. You have the slide. Online, they do have the slides. So you will see that attendance of a record that'll help you with your continuing ed credits. There's gonna be a brief survey on there so that we can get your feedback. It takes about 2 to 3 minutes to get that. We will also include Sam's slides in that particular email. The 112, I'm just getting where there's 112 written pages, so do check your spam in case it goes there. Okay, it's a link. All right. And then also you have a piece at at each of your spots about the Community Foundation. That's by popular request that we're asked how we are a resource for you, for your clients, a neutral charitable entity that helps you meet your clients' goals. So that goes along with you. It also has our contact information. So if you do not see that email, if it went to your spam, you can contact one of us through that. And then finally, this is a series. Our next one is in the spring, April 29th. We will have another session, so please be on the lookout for that. All right, that concludes our program. We're so pleased you joined us tonight. Thank you.